Thank you. So the yield curve is the maturity with the corresponding interest rate. Maturities less than 1 year are the money market. Maturities greater than 1 year are the capital market. Okay? So the yield curve, the determination of the interest rate is determined through the Fisher equation. And that's Irving Fisher. And the equation is nominal interest rates equal the real rate plus inflation expectations. So the real rate, in most cases, is really the base rate of return by bond investors. And usually that real rate is fairly flat and stable over time. It doesn't move very much. The movement in interest rates, particularly long-term interest rates, really comes from movements in inflation expectations. And I use inflation expectations specifically. It's not inflation measured by the producer price index or the consumer price index. It is inflation expectations expected by bond investors in the bond market. So inflation expectations are extremely volatile. They change every minute, every day. So any movement in inflation expectations makes a corresponding movement in the nominal interest rate. So if inflation expectations holding the real rate constant goes up, then the yield curve overall will go up, shift up. If inflation expectations go down, the yield curve will shift down across what is called the yield curve. It's also called the curve. It's also called the term structure of interest rates. And I won't get into the geometric calculations or geometric average of determining forward interest rates using the geometric average, but I'll leave that up to you to take a look at it. But just remember that the yield curve is also called the term structure of interest rates. It's interchangeable. We talk a lot about the short end of the term structure, short end of the yield curve. We talk about the long end of the curve, long end of the term structure, but you will hear people say it's the short end of the curve or the long end of the curve. The movement in interest rates along the curve, if the Federal Reserve prints money and buys bonds, bond prices will go up and interest rates will go down. If the Federal Reserve starts to sell bonds in the marketplace, they will drive bond prices down and interest rates up. And the key tool, monetary policy tool that the Federal Reserve uses is open market operations. Those open market operations are conducted through the Federal Reserve Bank of New York. So movements in the yield curve are extremely important because, quote unquote, all debt and all equity securities are priced off of the yield curve. So in this case, today's case, we are going to be issuing 10-year bonds to invest in a 10-year asset. And the asset in this case is going to be the acquisition of a firm. It could be a real estate asset with the economic or physical life of 10 years. So in this case, we're going to use the 10-year. But again, all debt, all equity securities are priced off of the yield curve. So understanding just basic dynamics of the yield curve are extremely important because, again, they're the base rate. You also have to understand the different shapes of the yield curve. And there's basically three shapes. One is an upward sloping yield curve, a flat yield curve, and an inverted yield curve. The upward sloping yield curve is what is called a normal curve. And it basically, the upward sloping yield curve corresponds to the expectations hypothesis, which is basically the Irving-Fisher equation. So the Fisher equation, normally upward sloping yield curve, is the expectations hypothesis. To get back to the Fisher equation, in this case, an upward sloping curve means that inflation expectations are positive. In a flat yield curve, the expectations of inflation are zero. In an inverted yield curve, the expectations of inflation are declining or falling. So normal, upward sloping, flat with a zero inflation expectations. In this case, it's going to be positive. And then in this case down here, it's inverted. And the inflation expectations are declining or negative, depending on the severity of the potential recession. What's interesting is that the yield curves can go from normal to flat in both directions. They can invert, they can go flat, and go back to normal. So it's very fluid. What the yield curves can do over time. What's persistent, what I'll show at the end of this presentation, we'll go to the dynamic yield curve site, which is stockcharts.com, and I'll show you how the Federal Reserve uses open market operations to buy and sell bonds to manipulate interest rates. And you can see how the yield curve goes from normal to flat to inverted to flat to normal again as the Federal Reserve is trying to stimulate or cool the economy through open market operations. But what's interesting is, and you'll see it here, is that 9 times out of 10, when the yield curve inverts, the stock market peaks at least a year after. So an inversion in the yield curve is a precursor or a predictive indicator for a pending recession. So remember, 9 times out of 10, going back in history, when the yield curve inverts, the stock market peaks within a year later and the economy falls into a recession. And the reason that is the Fed has seen that the cost structures and inflation pressures are getting out of control. They move into the marketplace, and since the Federal Reserve controls the short end of the term structure or the short end of the curve through open market operations, they will be selling bonds, driving down bond prices, driving up interest rates to increase the cost of capital to cool the economy.